GNG Electronics Limited Q4 and FY26 earnings conference call. This call may contain forward-looking statements about the company that are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Avinash Karumanchi from Motilal Oswal. Thank you, and over to you.
Thank you, team. Good evening, everyone. On behalf of Motilal Oswal Financial Services, I welcome you to fourth quarter FY26 earnings call of GNG Electronics Limited. Joining us on the call today are Mr. Sharat Khandelwal, Founder and Managing Director, Mr. Ajay Pancholi, Director, Mr. Rakesh Jhunjhunwala, CFO, and Mr. Rohit Agarwal from MD's office. Now I hand over the call to Sharatji for his opening remarks. Over to you, sir.
Good evening and thank you everyone. I welcome you to the Q4 and FY26 earnings call of GNG Electronics. This has been a remarkable year for our company, one in which we have delivered our best ever annual performance, expanded our footprint, deepened our customer relationships, and substantially over-delivered on the guidance we set out at the beginning of the year. I would like to begin by thanking our shareholders, customers, channel partners, suppliers, and most importantly, our 2,148 colleagues across geographies for their commitment and execution that made this performance possible. Q4 FY26 has been a milestone quarter for us. Consolidated revenue grew 43% year-on-year to 651.7 crores, and profit after tax nearly tripled to 42.1 crores. EBITDA margin for the quarter expanded to 9.8%, an improvement of nearly 307 basis points over Q4 FY25, while PAT margin expanded to 6.5%, which is an improvement of over 323 basis points year-on-year. For the full year FY26, consolidated revenue stood at 1,891 crores, representing a year-on-year growth of 34%. EBITDA margin during the same period improved to 10.6%, an expansion of 166 basis points over financial year 25. And profit after tax grew by 91% to 132 crores, which translates to PAT margin expansion by 209 basis points, which is 43% increase from 4.9% to 7%. We have by far exceeded both the original guidance we shared at the start of the year, as well as the revised guidance we had communicated in our Q3 earnings call, both on revenue growth and on profitability. Our CFO Rakesh ji will walk you through the detailed numbers shortly, but one thing is very clear. For the full year, we have delivered healthy growth, supported by strong demand across both domestic and international markets. Our revenue growth trajectory has remained strong, and more importantly, profitability has scaled faster than revenue, with improved realizations and stronger margins. As we had indicated in our previous earnings calls, we continue to see margin expansion driven by better procurement, tighter execution, and strategic inventory positioning, which has allowed us to benefit from the prevailing industry dynamics. What is particularly encouraging is not just the growth we are delivering, but the quality of that growth. Our business continues to remain asset light but working capital driven, allowing us to scale efficiently without large fixed investments while maintaining flexibility in a dynamic environment. Our margin expansion is also driven by greater distribution reach we have built across geographies, that is across India and in international markets. As we move closer to the user and as our products continue to gain greater acceptance, supported by devices that are at par with new in terms of both performance and aesthetics, backed by reliable and proven warranty, resulting in combined strength of our product and service offering, making our product and value proposition even more compelling. This in turn allows us to price our products better, which directly translates into a stronger margin profile. We continue to expand our global footprint. As of the end of financial year 26, we now supply to 46 countries, up from 38 countries at the start of the year. Our customer-facing reach has grown to 4,895 touchpoints across enterprises, institutions, distributors, and channel partners, compared with 4,154 at the beginning of the year. Our supplier base has expanded meaningfully as well, providing us with deeper, more diversified sourcing across geographies. To support this growth, we have continued to strengthen our team. Total employee strength has now crossed 2,100, with substantial addition to our engineering, sales, and procurement functions through the year. This investment in talent is what has enabled us to scale our refurbishment capacity, deepen customer engagement, and expand our distribution reach without compromise on quality. We have also strengthened our marketing team, which is now actively driving multiple campaigns and programs aimed at expanding and amplifying the Electronics Bazaar proposition to a wider global audience. Let me share a few specific initiatives. First, on the consumer-facing financing front, we are launching a flagship affordability program, making a premium refurbished laptop available to end customers through our dealers at as low as 1,000 per month through structured EMI partnerships with leading consumer finance players in India, and similar tie-ups being explored in our international markets. This program, we believe, will meaningfully expand the universe of customers we can reach, particularly first-time computer buyers, students, and small businesses. Second, we have continued to invest in deepening our channel engagement through regular on-ground channel partner meets across major cities, including recent meets in Thane and Ahmedabad, which we will continue to scale through financial year 27 to strengthen our distributor and dealer ecosystem. And third, we have rolled out targeted performance digital marketing and influencer-led campaigns, partnering with renowned tech influencers such as Rajiv Makhni to build category awareness and elevate the Electronics Bazaar brand among consumers and enterprise decision makers. Together, these initiatives are translating into greater customer reach, stronger brand recognition, and ultimately healthier sales and margins. Also, our team continued to participate in international trade shows across US and Europe throughout the year to nurture and enhance our business partnerships. On the distribution side, as covered in our recent press release, we have formalized strategic partnerships with India's leading technology distributors. While the full impact of these partnerships is yet to be seen, the early signs are encouraging, and we look forward to scaling these relationships meaningfully over the coming years. Let me now turn to the broader industry, because the developments over the last 6 months have been truly defining for our segment. As I have been highlighting since our Q2 call, the global PC industry is undergoing a structural shift driven by AI-led memory diversion. Since then, the situation has only intensified, and importantly, it is no longer a memory-only story. Storage, processors, and other key components are now seeing comparable price escalations. More importantly, there is supply constraint of brand new computers on account of shortage of critical components. Let me share some specific data points to illustrate the magnitude of this shift. As I had referenced in our Q3 earnings call, an 8GB DDR5 memory module was priced at $23.35 on October 1st, 2025, rising sharply to $86.61 by January 1st, 2026. As of April 1st, 2026, the same module is priced at approximately $120, more than 5 times its level just 6 months ago. The 16GB DDR5 module has followed a similar trajectory from $54.85 on October 1st to $189.99 on January 1st and approximately $210 as of April 1st, close to 4 times in 6 months. More importantly, again, as I had also mentioned in Q3, this is no longer just a memory phenomena. The same pattern is now clearly visible across other key components. 1 TB SSD, which was priced at around $70 on October 1st, 2025, rose to $180 by January 1st, 2026, and is now approximately $249 as of April 1st, a 3.5 times increase in 6 months. A typical high-end processor has risen from $165 on October 1st to approximately $240 as of April 1st, up roughly 45%, with CPU lead times now stretching, in many cases, to as much as 6 months. The impact of these component price escalations is now flowing directly into price of new laptops. To give you a sense of the magnitude, a typical entry-level laptop with 8 GB RAM and 512 GB SSD, which was selling in China in India for around 25,500 as on 1st December 2025, rose to approximately 32,500 by January 1st and is selling today at close to 40,000. An increase, which is an increase of nearly 57% in just 6 months. The story is similar in international markets. A comparable laptop, which was priced at around $315 on October 1st, rose to $375 by January and selling today at approximately $440. This is an increase of around 40% in 6 months. This is the new reality of the new PC market, and it makes the value proposition of credible branded refurbished PCs supplied by Electronics Bazaar stronger than ever before. Let me mention in good measure that illustrations that have been given are of entry-level brand new computers, while we deal in high-end refurbished computers. An end user can now buy a premium high-end refurbished computer by us at a better value than an entry-level brand new computers. The March 2026 IDC update conveys this opportunity more clearly. According to IDC, global new PC shipments stood at approximately 285 million units in 2025. IDC has further cut its 2026 PC shipment forecast to a decline of around 11%, a further decline from 8.9% that was projected earlier. In absolute number, this implies a reduction of roughly 32 million units in 2026 alone. But the real picture is even more striking. Under normal circumstances, 2026 was expected to be a growth year for PCs because of the AI PCs adoption wave. So when you compare the 11% expected fall against the roughly 10% growth that the market would otherwise have delivered, you are looking at a cumulative gap of approximately 55 to 60 million units of computing demand that the new PC market simply will not be able to serve in 2026. I repeat, this is a gap of 55 to 60 million units of computing demand that brand new computers will not be able to fulfill. The unmet demand is logically finding its way to the refurbished segment, and we continue to fully harness this opportunity. The end demand of computing isn't disappearing. As I had said in our Q2 earnings call, by the end of the year, AI would change the landscape of how we do things, and that is exactly what we are seeing playing out today. And we are just scratching the surface of what AI is capable of. AI is making computing more, not less, central to how enterprises, governments, students, and consumers operate. What is changing is where that computing demand is being met. And in this shift, refurbished PCs, particularly those backed by new quality and a credible warranty, represent the most viable and economical alternative. Thank you. I would now like to hand over to our CFO, Rakesh Ji.
Thank you, Sharadji, and good evening, everyone. I am happy to share that we have closed FY26 with the strongest ever quarterly and annual performance, capping a year of consistent execution, disciplined growth, and a meaningful expansion across the board. Let me first walk you through the Q4 numbers. During the quarter, consolidated revenue grew 43% year-on-year to rupees 651.7 crore, driven by sustained demand momentum across both our domestic and international markets, particularly the Middle East, the United States, and Europe. Gross profit for the quarter stood at rupees 125.3 crore, with gross margin expanding to 19.2% from 15.1% in Q4 FY25. A sharp improvement of 414 basis points, reflecting better procurement, sharper inventory positioning, and improved realizations. EBITDA for Q4 stood at rupees 64 crore, with EBITDA margin at 9.8% versus 6.75% in Q4 FY25, an improvement of 307 basis points year-on-year. Profit after tax for the quarter nearly tripled year-on-year to rupees 42.1 crore, with PAT margin expanding to 6.5% compared to 3.2% in Q4 FY25, an improvement of 332 basis points. Coming to the full year, FY26 consolidated revenue grew 34% year-on-year to rupees 1,891.1 crore. Gross profit grew to rupees 380.9 crore, with gross margin expanding by 225 basis points to 20.1%. EBITDA grew to rupees 200.5 crore, with EBITDA margin improving by 166 basis points to 10.6% versus 8.9% in FY25. Profit after tax nearly doubled to rupees 132 crore, a growth of 91% year-on-year, with PAT margin expanding to 209 basis points to 7% up from 4.9% in FY25. We have delivered massive revenue growth in India, with consumption revenue going up from 345 crore to 622 crore in FY26, increasing by 80%. Overall, FY26 has been a year of strong all-round performance, with significant revenue growth, meaningful margin expansion, robust capital efficiency, and a strong balance sheet. We enter FY27 with healthy momentum, strengthened the team, expanded distribution, and structural industry tailwind that Sharatji has spoken about. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Chandresh Malpani from Niveshaay. Please go ahead.
Hello. Am I audible?
Yes, go ahead.
Yes, Chandresh. Yeah. Thank you so much, sir, for the opportunity, and congratulations on this great set of numbers. Sir, my first question is basically on the volume numbers for this quarter and the average selling price.
Yeah, sure. Thanks, Chandresh. So let me give you first the volume number for the full year. What the volume number for the full year is about 7,27,000 odd in comparison to 5,90,000 odd. Okay. And broadly, this is again the breakup of this is almost 81% in laptops and 19% in other than laptops. Furthermore, to your question in terms of the last quarter, the breakup of laptops is about 176,000 laptops and 65,000 others. So that basically brings the quarterly number to about 241,000. Coming to the ASPs for the quarter just ended, for laptops the ASP is about 30,000 odd rupees, and for others it is about 19,000 odd rupees. On a blended basis, this number translates to 27,000. If I were to compare this on a full year basis, my ASP on a blended basis, the ASP is about 26,000 rupees. And furthermore, for laptops, it is about 28,800, and others it is about 18,300 rupees.
Okay, got it, sir. And basically, if I compare with the Q3 numbers, where we were also keeping elevated inventory levels because of the reasons that you mentioned in your opening remarks. So why? I mean, the average ASP on a blended basis have gone up by 1,000 rupees. But the gross margins have not directionally followed that. So what could be the possible reasons here?
So if you look at basically what happens is Q4 at times we also, and we've had this earlier as well, there's always a push of volume over margins. So at many times we need to push that element as well. That having said, if you look at our quarterly Q3 vis-a-vis Q4, the ASPs have increased by almost from 29,000 for laptop to 30,000 rupees, and on a blended basis from 26,200 to. So the realization better, but also be mindful of the fact that this quarter, as Sharadji mentioned in his opening remarks, has been really transformational as we are building capacities, getting ourselves prepared for the future as we roll forward to the next year. So there are certain investments that, whether it's in terms of people or processes, etc., that get reflected in the numbers as well. So you should not necessarily. Also, more importantly, if you look at the corresponding quarter, right, the delta is significant in terms of margins as well. Yeah. So, but you would have to weigh in the overall dynamics on the final outcome.
Okay. No, sir. What I want to bring out is here, because we are again back to our debt levels of pre-IPO. I mean 400 odd crores of borrowings is again at this March balance sheet. So again, our strategy of keeping the higher inventory, because as at this year end we are about 700 odd crores of inventory. So we are confident of that strategy, right?
Yes, we are confident of the strategy, and just for the wider benefit of people on the call, I'll just address the debt position levels as well relative to what guidance we had given at the end of the last quarter. And I'll also share this in comparison to the March 25 numbers. So in terms of March 25, the net debt was about 383 odd crores. This included a shareholder loan of about 60 odd crores. Okay. If you look at the same number at the end of March 26, this number is, the net debt is about 300 odd crores, and this does not include any shareholder loan has also been paid off. Now, it will be pertinent to note that the same position as of 31st December, the net debt number was 466 crores. That has gone down to 300 odd crores, right? So as relative to last year, which was 383 crores, it is now 300 odd crores. But yes, you are right. We continue to maintain strategic positions on our equity. And yes, the participation of our shareholders in terms of the IPO as well as the profitability has given us that additional leverage to take that strategic position in terms of how we see the opportunity and how we can juice up the opportunity in terms of our inventory levels. And the tailwinds actually are helping us to take that strategic position.
Okay, thank you so much, sir. This was helpful. Yeah.
Thank you.
Thank you.
Next question is from the line of Sunil.
One thing, Sharadji would like to add
something here. Due to the price increases, as I mentioned, in processors and now in SSD and memories, earlier in memory, now processors and SSDs, the price of brand new computers are increasing like anything. And we are in a situation where the prices will keep on increasing through 27 end. There will be we can call it a stable price increase, and it makes it imperative for us to keep elevated levels of inventory for us to be selling them at a better price and maintaining our margins and even increasing the margins. So we have to buy ahead of the price increase curve, and the need of the hour is to keep high levels of inventory. It makes all the more commercial sense for us.
Thank you. Next question is from the line of Sunil Jain from Nirmal Bang Securities. Please go ahead.
Yeah, thank you very much for the opportunity, and congratulations on good numbers, sir. My question again relates to inventory which you are maintaining high. Even after having a peak quarter of sales of almost around 600 crore plus, 650 crore plus, you still have inventory, very high inventory of over 700 crores. So is this likely to continue, as you said, till the end, and you will keep on keeping the inventory of almost around 4.5-5 months?
So I would thanks for your question. Let me address this in a couple of ways. Okay. So if you look at our inventory levels at the end of last year, that number was about 490 odd crores. If you look at the same number at the end of 31st December, which is the end of Q3, that number was 683 odd crores. And the same number is 743 crores now, right? Now, as I think it's very important for you to relay upon the market dynamics as to how we are seeing the market dynamics playing out, which is in terms of component prices, memory prices, and so on and so forth. So that helps strategically. This inventory level strategy helps in the overall strategy going forward, because the way we see this is this actually adds substantially to our capability to add on to profitability. So inventory levels at about 740 odd crores as of March end. While you may say that this number is almost 3-4 months of quantum, but we see this as the real opportunity, and we see this to really add on to our profitability going forward. So this is a strategic thought. I think you've seen the enhancement in inventory levels at the end of last quarter and this quarter as well, and we've given the rationale even then as to why we have strategically brought up this position, and all the data points mentioned by Sharji earlier in terms of how entry level machines have moved in terms of pricing, how the component pricing has moved, and that really gives us the confidence that these inventory levels will be fruitful from an overall perspective for our business.
Apart from this, even the debtors level, which was at around 0.6 in last year, has moved up to over 1 month, means 1.3 per month.
Yeah. So
what is the reason for that?
Yeah. So at the end of December, the debtors were at average receivables were at about 285 crores. That's gone down to 206 crores at the end of March. Okay, and this is again, as we've emphasized, this business. If you understand the key moat of this business or the key dynamics of this business, this will be asset light, but working capital consuming, right? And furthermore, to say, as we have added more partners in our distribution strategy, we will need to support our partners even for new machines. When the partner sells new machines, they are given credit by the OEMs, and that credit is ranging from about 30 to 45 days. And our level of credit is no different than there. So we have to be competitive and place the proposition such that the distribution channel also equally does not see this as a different mechanism, and they promote our product also with the same vigor.
Yeah. So the one
if I may add that we have gained a level of institutional trust, and now there is a successful validation from global distributors who previously handled only new equipments. So in this segment, the credit will be very, very important for us to be able to push an entire distribution channel for refurbished products to be sold in the segment where heretofore new computers were being sold. As refurbished computers are becoming now a real alternative, refurbished by us with 1 year to 3 year warranty equal to new features, and equal to new feature with credible warranty is becoming an alternative. So we have to funnel this channel for us to reach the end customer, and credit is paramount for that to happen.
So the conclusion is that the working capital cycle, which has elevated in the current year, will continue to remain elevated for at least near term.
Yes, that's correct. The reason being that we are in a situation of extreme shortages because of hyperscalers and shortage of SSD, RAM, and processors. Even I may add, the brand new computer shipments are reducing because of supply crunch. So and the prices are increasing. So we have to take strategic stock positioning, also to sell material to the global tech distributors for us to reach the right customer, right business customer.
And sir, if you can share guidance for next year, if possible.
Sir, next year guidance we can give at around 25% revenue growth and on PAT level growth around 0.5%.
PAT level growth?
And we should look at this on the PAT level growth, an increment of at least 50 basis points from the current level. So this is on the back of almost 200 basis points. Yes, margin expansion, about at least 50 basis points on the back of the substantial growth that we have delivered this year.
Okay, sir. Great. Thank you very much. I'll come back in the queue.
Thank you. Next question is from the line of Nishant Sharma from Nuvama Wealth PCG Research. Please go ahead.
Thank you for the opportunity and congratulations for great set of numbers. My first question is around on the margin side. We have seen a sequential decline on the margin. Partly you alluded that this is because of the investment on capacity builder, people and processes. Just wanted to understand what kind of impact could be because of these parameters on the margin on a sequential basis. Hello, am I audible?
Yeah. So So the way we should look at it as the guidance strategy has given. So broadly, we are seeing that there will be an improvement. You should look at it from a trajectory perspective. There will be an improvement quarter over quarter going forward. Typically, you have seen that at least in the last Q4 of this year, Q4 of the previous year, and earlier periods as well. We've always seen the Q4 margin to be a bit subdued because it runs on the back of substantial volume growth, right? Because that is the period as we had alluded earlier as well, year-end period, strategic purchases or large bulk purchases, etc. And hence we have to give that push to the overall ecosystem. So in terms of quarter over quarter, we see you should look at the trend from as how we have grown historically. We'll add up on top of that over quarters.
Okay, and just want to understand, basically, even in previous quarters, we have broadly very confident in achieving 25% revenue growth trajectory for next couple.
You're not audible, please.
Sorry. No?
Okay, could you repeat your question?
Your handset mode. Yeah.
Am I audible now? Sorry.
So you're able to hear him?
Yes. Am I audible now?
Yes, you are.
Yeah. So I was asking that historically or last couple of quarters we have been very confident in achieving 25% kind of a revenue growth going forward for next couple of years, given the huge industry tailwind that we are seeing. Apart from that, we have also added new distributors in our kitty. So don't you think that 25% seems to be on a conservative side, and given the new distributors coming in, we can easily outpace this number?
Nishant, yeah, you are right. We like to give conservative estimates.
Okay. And last question on around distributor side. When we have added new distributor, what kind of currently they are holding the inventory of refurbished laptop at their distribution kitty or warehouses, and vis-a-vis what is their thought process in terms of taking it as a overall inventory at their levels?
Distributors are very, very excited on this business. Their team, their channel partners are accepting this proposition in a very, very excited way, right way. And in terms of inventory, what they are keeping is between 30 to 45 days of inventory that they usually keep. Is very much required for doing the distribution the right way. And it is in line with the brand new inventories that they usually can keep. In fact, it may be lower than that.
Broadly, my question was around in terms of percentage of shares. So suppose they are keeping 100 new laptops. So what is the kind of number that they are keeping it for refurbished laptop and going forward?
That is difficult for me to answer the question what they will do, but it will be a small percentage. But
right.
Definitely we intend to grow with them, and our proportion in their overall kitty, our pie in their overall kitty will increase.
And any new distributor partnership that is in lined up?
Yeah, we are in talks with various distribution partners around the world, and as and when they materializes, we will give the right press release for the same.
I'll fall back
I
in
can
queue.
tell you the discussions are in advanced stages in Europe and in the United States.
Okay, that's great, sir. That's great. Once again, many congratulations, and I'll fall back in queue. Thank you.
Thank you. Next question is from the line of Asta Jain from PKT Advisors. Please go ahead.
Hello. Thank you for the opportunity, sir. My question is with respect to other expenses. So for this year, it has increased by 40% on YOY basis. So can you tell us that what is the reason for increase in other expenses?
Am I audible?
Yes.
Yes.
Yes. So the other expenses substantially are on account of freight, marketing, and insurance, right? If you look at, while you say that yes, it has increased by almost 40%, but one should by 37 odd %, one should also look at this number on the back of the revenue line as well. Is there an increment of about 5, 7 to 10 basis points more than what we had anticipated? Possibly, yes, especially in the last quarter on account of the increased freight on account of the situation that we are all dealing with from a Asia perspective. But it is pretty much in line. I don't think it is out of whack at all.
Understood. So my second question is with respect to revenue breakup. I wanted to know, can you give us revenue breakup by geography?
Yes. So the revenue breakup by 1 second, I'll get to it. So for the full year, India revenue is about 33 odd %. UAE is at about 12%. US is 21%. Europe about 20%. And the rest of the world is about 14%. So in a sense, US and Europe put together is just at about 41%, and India at 33%.
Got it, sir. Thank you.
Thank you. Next question is from the line of Paras Cheetah from Purple One Vertex Venture LLP. Please go ahead.
Yeah, thank you, sir, for this opportunity, and congratulations for the wonderful set of results. Sir, just two queries. Firstly, sir, due to this Iran war, was there any impact on our operations at Sharjah or either sales, etc., in terms of the supply chain or logistics?
Yeah. Hi, Paras. Thanks for this question. I was expecting it.
Yeah, because I was really worried about this Sharjah facility, actually.
But let me assure you that the situation here, it is quite normal. The government of UAE has handled situation pretty well. Very high rate of interceptions, and our facilities have been up and running every single day. Our shipments happen by air, so that are also uninterrupted. The blockade that is here in Strait of Hormuz, we are not impacted by that. And pretty much the life in UAE is as normal as it could be given the circumstances. It is not ideal. I am speaking to you from Sharjah as we speak, so you can imagine situation is pretty normal. Yeah.
Right. But so
we are concerned, our facilities are working and shipments are happening. Yeah.
Understood, sir.
Yeah.
Understood, sir. So basically, the shipments by air has been normally as it is since the time it has been operating. Is it or okay?
No.
Or was it normally through the containers? Yeah.
No. We are making the shipment by air. So that is apart from minor delays, rest of it is okay. And we also, let's understand, we keep very good inventory position in Europe and America too.
Right.
It's not that we have inventory only in Middle East. So what we ship to our US office, bulk of the inventory we keep it there, and from there it is sold to American and European markets also. Yeah.
But procuring your supply parts, etc., was that a challenge, or that has also been handled?
No,
I mean, we can obviously see the numbers.
We have not faced any operational challenges on account of this war. There is a ceasefire in place for last 30 days. Some minor skirmishes did happen yesterday. But apart from that, situation is pretty normal. No operational challenges to us at all whatsoever.
Oh, that's nice to hear. And secondly, sir, I mean, I just heard about this, price rises in the new laptops and the component parts, etc. I mean, just I was offhand and, I may be a little bit underrating this, but in terms of margin expansion for ourselves, the benefit out of this huge tailwind, the price rise so far for us has been quite nominal. So is there a scope for a significant margin expansion now for this year, or this is where, things stabilize in terms of margins now?
No, see, we have given you guidance of 0.5% in terms of PAT expansion. This will be obviously on the back of margin expansion.
Right.
And we are also making more inroads and trying to establish ourselves as a structural giant in circular economy. And
Okay.
The idea is to gain more acceptance across wider audience of business customers in overall market. But the margin expansion is also part of our strategy. So we'll find the right balance, and the margin expansion definitely will also be there in apart from top line expansion.
Right, sir. And so this last paragraph, in terms of, inventories are understood to some extent. There's only one thing, we have strategically positioned, high inventory given the situation that is prevailing currently. But at some point of time, and we'll also be rising on the debt curve, etc. And if there is a, cycle disruption, there is some black swan event, is there an inventory sort of risk that we are sitting on, or we will be able to manage it?
No, not quite, because if we have kept strategic position of inventory, they are bought at comfortable prices. We have not bought them at higher prices, let me assure you that. And
right.
Yeah, so we are in a situation where we have bought inventory at lower prices.
Understood, sir. Fair enough. Okay, thank you so much.
Thank you. Next question is from the line of Hiten Borisha from Sequent Investments. Please go ahead.
Yeah. Thank you for the opportunity, sir. So my question is again on the margin. So you mentioned our top line will grow at roughly around 25 or more than 25%. So question I want to understand is what kind of EBITDA margin we are looking, because I think the cost will not move parallel with the top line, right? Our employee cost and other expense will remain low. So are we looking at like 11-12% EBITDA margin for this year?
Yes. So if you look at last year, our EBITDA margin was shade below 9%. As we speak, we have grown this to about 10.6% for the full year. The guidance that we have given is enhancement of at least 50 basis points at the PAT level. So it would be fair to assume that it will be at the EBITDA level, it will be a shade higher. So from 10.6, will it be about 11.5 or thereabouts? In order to achieve the guidance, we'll have to deliver that number.
Sorry, sir, you mentioned from 10.5 to, you were not audible in between, sorry.
10.6 to 11.5
okay.
or thereabouts. In order for us to deliver at least a 50 basis points PAT expansion.
Understood. And so my second question is on the finance cost. It has gone up from, I think, 9 crores to 14.5 crores quarter and quarter, which is largely because of the working capital. But you mentioned the prices of the RAMs and inventory, it is eventually gradually going to go up in this year also by end of Q4. So are we expecting this run rate, 14-15 crores kind of quarterly run rate to go up, or is it going to sustain here?
It's likely to sustain. The way we should look at this, it's likely to sustain. As I guided at the end of last quarter, we had indicated a debt position of about 450 odd crores, which was 466 crores, which was at the end of December. We up to that level, we are pretty comfortable. That having said, as of March end, we've got that number down to about 300. So it should be in that trajectory is what we expect going forward.
Understood. Okay. Thank you, sir.
Thank you. We'll take our next question from the line of Raj Saraf from Finvestors. Please go ahead.
Yeah, so congratulations on the great set of numbers. Sir, I missed your initial commentary. Sorry for that. I just wanted to ask, sir, like the margin compression is the last quarter, and if I can see, even the previous year the margin was compressed for Q4. So you mentioned the reason. So can I assume that the margin is going to be slightly above the concluded quarter, starting from the Q1 only?
Yes, it's fair to assume that.
Okay, sir. And sir, what is the employee count for our companies and refurbishment capacity and the utilization level?
Sorry, I missed the question. Could you repeat?
Sir, employee count as of now, or if you can say it as of 31st March 2026, and the refurbishment capacity and the utilization numbers, utilization percentage, sir.
Okay. Yeah, sure. So the way we should look at it from a employee count, our number is about 2,148 odd percent. 2,148. Of this, about 1,800 is production technicians. And also, we should look at this that as compared to last year, this number was at about 1,200 odd employees. This has grown to about 2,150. And there's a significant addition that has happened in the last 3 to 4 months. So the way we see this is that the productivity will enhance going forward in the coming quarters on account of the capacities that we have put in place in terms of the people, as well as the infrastructure that is required has also been enhanced so that we can grow at a much faster pace. So capacity-wise, it's not a challenge. We are well geared up.
So right now, sir, if you can just give a number on how much units per month we can refurbish.
So if you look at the number, for the full year, we have done about 7,26,000 odd. So that will give you a number of about 61,000 odd, right? And can this
from the capacity standpoint, from the people that we have, and from the space that we have taken strategic space positions in the UAE as well as in India. In Mumbai, we had one facility which we expanded to, and in UAE we had earlier 3. Now we have 8. So from the capacity we are and with the employee cost, the productivity is also going to increase. We can say that we have capacity of doing around 150k units a month.
Okay, 150k units per month. Okay. Yeah, sir, and the effect of the West Asia, which you just concluded, there is no effect as such because we are shipping through air route. So are we, yes, sir, 100% the old laptops or all the laptops we are taking for refurbishment are taking from air routes only? No water routes yes, involved? 0% water route?
No. We are taking inward and outward, both are by air.
Okay, and there is a nil effect of West Asia. Just right now we have heard some hostility in last 1-2 days, so there is no effect on our production sites.
Yesterday, no. Okay, obviously not. I am sitting in the UAE only. Yesterday there were, I think, some 7 or 8 missile strikes, and there is a very good interception rate up to the point of 99.5. So they are intercepting all the incoming missiles. And couple of missiles that are coming, they are falling the sea or on the tail end. Where if you see the main road in Dubai, Sheikh Zayed Road, Dubai Mall, Burj Khalifa, they are all proudly standing tall. There is no impact. We don't see any impact of destruction whatsoever on the road, on the surface at all. But yes, when we read that in media, we see a different picture.
Okay, so why am I asking this, sir?
We have operated, we have operated at normal, in a very normal manner, even within the peak of the situation, right? So, and we are reasonably certain that if we continue to operate the way we are, we have not seen the impact of the logistics, we have not seen the impact of the production facilities, we have not seen any impact from on the people availability, etc. So I think things should be looked at in that context.
Okay, so why I'm asking this, sir, because our huge facilities lies in there. So are we planning further to augment our facilities out of UAE anywhere for taking future in view, sir?
See, it's a very early situation. It's around 2 months, 5 days old. I believe it's my informed belief that situation should get normalized very soon. And we don't see need for moving to any other location or any other place. I think we will remain as safe as ever.
Thank you very much, sir, and just best of luck for next financial year and beyond further. Thank you.
Thank you. We'll take our next question from the line of Anuj Haria from Interglobe Services. Please go ahead.
Hi, thank you for the opportunity. My question was around the average selling price, right? Since you mentioned that there's been a continuous increase in the price of storage, processors, and memories. Quarter on quarter, can we see an increase in the average selling price? Like this quarter, the average selling price for laptops you mentioned was approximately 30,000. So let's say in quarter one of this year and quarter two, can we see an increase in the average selling price?
We've seen this trajectory over the last 3 quarters in terms of the betterment of the realization, right? So if you were to ask me that will this trajectory continue, we hope it continues, but we have to be at the same point of time very dynamic in the pricing and strategy so that we continue to deliver the numbers and not necessarily hold on for the margin itself, right? But we anticipate that with the outlook that is there on the key components, the probability of a better realization is reasonably high.
Got it. And just a follow-up question. So in the current financial year, do we plan on adding any additional manufacturing facilities? And by the end of the year, what is the approximate headcount that you see?
So at this point of time, from the point we have taken already sufficient space for our refurbishment facility, so we don't envisage the need for any further facility at this point of time. In terms of the manpower count at the end of the year, it is not possible for us to predict to say that at the point of the time, but obviously it will be much more than what we have now.
And to supplement that, we continue to add to the marketing team and the marketing force so that we can penetrate further. As we mentioned that we have significantly built up capacity in terms of people or technicians. So that will provide the fillip to the growth for the immediate year. That having said, we will be very strategic. We will be very mindful as to how much we grow depending on the need. And as we said earlier as well, we have whether it's the operating capacity, the space, the people, we have all of that in place significantly for the year. The focus will be significantly on enhanced marketing, and the marketing role will be a higher focus than well, there's focus required on every element, but marketing will be on the higher side.
Got it. And just a follow-up question. So in the month of February, we partnered with Ingram and Supertron. So from February till March, or let's say till April end right now, can you just share the amount of revenues that we have generated from these two partners?
We are just scratching the surface with these two partners. The number that we aim to achieve will be much more than what we have done on an average basis. Yes.
Okay. Can you just
share the specific number?
Okay, a percentage?
It's a very small percent. It's a minuscule percent, I can tell you this.
Okay. So we are yet to see the growth from these partnerships, let's say in the coming year, the current year, sorry.
Yes, that's correct.
before this financial year, your inventory cost was lower, but now your inventory which you are procuring now, that cost will be higher. So going forward, can we assume that margins can decrease also? There are chances if prices fall.
No, not quite, because we are buying. The chances of prices falling are not there. There is because of the component prices increasing. Memory is just not used in computer. It is used in EVs. It is used in watches, smart watches, smart rings. Lot of other places it is used. SSD shortage is there, so hyperscaler expansion is happening. And just remember who are the people who are funding the hyperscalers are companies like Amazon, Alphabet, Meta, and the likes, who are sitting on huge cash pile. So this is not going down, and we don't see any situation. And I have in good authority the information, knowledge, and market insight. The prices are not going to go down to 20 before 20th January. In any case, it is not coming back to what it used to be. Even if the prices will go down, we are seeing a situation with the price increase. Only thing, it might see a correction, but that is not happening before 28. But it is not going to come back to what it was, say in November of 25.
For currently, prices are almost up for 5 to 6 times. So even if they fall 20 to 30%, will there be any contraction in margins?
No, that said, you should be mindful that while our realizations are better, even if there's a correction, our ability to the input cost has not risen that significantly. So we have been strategic in terms of adding inventory, but our input cost has not increased significantly. To your concern on the risks associated with what if the prices go down, will we be impacted on the inward inventory? The answer is no. We are reasonably insulated because of our input costs being reasonably controlled.
Okay. Understood. Thank you.
Thank you. We'll take our next question from the line of Parikshit Kabra from PKD. Please go ahead.
Hi. Thank you and congratulations. I want to follow up from the previous question itself. My understanding of the strength of our balance sheet to build up this inventory, to expand volumes rather than necessarily expand margin. That's our strategy for this year. Is that a fair understanding?
Well, I'll say right balance of both.
Okay.
Right balance of both. But if this is the line, this is the time when we can really expand and expand our proposition exponentially. So I think if we are able to do that, we should do that. So demand isn't the bottleneck in this category. The trust is exactly what we said.
Makes sense. So let's play this out for another year, Sharadji. But assuming that this cycle goes on, let's say not only till Jan 28, but even till Jan 29, and if the growth continues at this speed, and as intensive, working capital intensive our business is, do you foresee needing to raise capital again this year?
No, we don't see that situation, and we obviously the inventory will not go to we'll continue to monitor our inventory also. We say by 28, 29, we do not see any need for any capital infusion in the company, and we will be able to manage on the basis of this and on the basis of cash flows.
Perfect. So last question.
Also be mindful of the fact, one thing, also be mindful of the fact that the equity base is reasonably comfortable, right? That having said, and on the back of that, our debt level is at about 300 odd crores. So there's reasonable headroom available for there being no real visibility in terms of need for equity as we stand.
Got it, sir. Thank you. The last question I had was the debtor days, as someone had raised earlier, had risen to about 40 days now. And you explained that there are new distributors who require a certain level of credit. But should we assume that it will now remain stable at 40-45 days, or is there a chance that this can get more?
No, we intend to maintain them at these levels. We do not want to increase them any further. And the reason why debtors days are this, because we are going in a territory which was heretofore wholly the domain of brand new guys.
Perfect. Understood.
Thank you.
Thank you so much.
Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Sharad Khandelwal for closing comments. Over to you.
Thank you. Thank you all for joining this call. So we are very excited. The journey that we started last year continues to grow, and the tailwinds are now available. These changes are permanent, structural, and fundamental. These are this new category creation necessity we started not only in India but entire international market, insulating us from country risk, channel risk, and other risk, refining greater acceptance. The proposition of our equal to new computers with warranty is making is an unbeatable proposition, and day by day we intend to capitalize on this. Demand isn't the bottleneck, trust is, and we are solving the trust. And trust premium is the high margin lever. That's all I can say. So GNG sits in a category where the direction is unambiguously up, and the winners are the ones who solve trust, and we intend to solve the trust. Thank you all for joining this call.
Thank you, members of the management team. On behalf of GNG Electronics Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.